Hello everybody. Today we are going to study IFRS 15, which is revenue from contracts with customers. Now you have already seen the definition or studied the definition of income as per the conceptual framework. So revenue is income generated out of ordinary course of business or activities. So it can take the form of sales, fees, commission received, interest received, etc. As you're aware, revenue is generally the largest amount in SOPL and therefore it forms a very important element in SOPL. But it is also an element which can be manipulated easily, and that is why it was important to form this IFRS, revenue from contracts with customers. Revenue will not include sales tax, VAT, GST or any other taxes collected on behalf of the third party. Now, when we talk about revenue from contract with customers as per IFRS 15, it has stressed the recognition of revenue based on transfer of control of the asset to the customer, that is the buyer. So when the transfer of control is there of the asset from the seller to the buyer, only then will the revenue be recognized. When we talk about transfer of control of an asset, it is the right and the ability to decide the use of the asset and to get all the benefits from the asset from the remaining useful life. So whenever you're talking about control, you have to remember all the rights to the asset are transferred. The right to use the asset in whichever way is decided by the customer or the buyer, okay, and all the benefits that the asset is going to yield are transferred, or the buyer has the right to all the benefits that he is going to receive. Now there are 5 steps involved in recognition of revenue. So we are going to do each step in detail. The first step is to identify the contract with the customers. Okay, so when we talk about a contract, it's an agreement between two parties that creates rights and obligation. So when I enter into a contract to sell my vehicle, okay, so the customer has the right to receive the vehicle and my obligation is that I deliver the vehicle, right? So the first step in recognition of revenue is to identify the contract between the customers. An entity can account for revenue only if the contract meets certain criteria. Only if there is a contract and if the contract meets the criteria. Now let's have a look at what the criteria is. The parties to the contract are committed towards fulfillment of their obligations. Okay, that means each party has the rights are identified and they are committed towards it. The payment terms are specified and they can be identified. The contract should have a commercial substance for it to be recognized as a contract under revenue, and it is probable that the selling entity will receive consideration. Okay, the contract can be either verbal, written or implied. Okay, so these are the criteria for recognizing a contract. There has to be a contract between two parties, and that identifying that contract is the first step in recognition of revenue. The second step is the performance obligation. Now, a contract includes a promise to deliver goods or services, and this promise is nothing but the performance obligation. So performance obligations are promises to transfer distinct goods or services to the customer. Okay, so the nature of performance obligation could be to provide the goods or services or to arrange for another party to provide the goods and services. We'll study this in detail in the later part. Okay, but the performance obligations are the promises to transfer distinct goods. When I talk about distinct goods, those are separately identifiable goods and services. So the entity would account for the performance obligation separately if the promised goods and services can be sold separately. That is what I meant. They should be identifiable separately. Okay, the example in this case is going to be a software company has developed a payroll software and has entered into a contract with the customer for the following. So the software company is going to sell the license to the software, license of the software, installation service. This may require updation of the operating system, but software does not require customization. So again, it is not correlated. Technical support for 2 years, and next 3 updations are part of the contract. So these are the performance obligations which are not really interlinked. You can sell each of these services separately also, right? This is an example of a service. The other example where the performance obligation can be identified for distinct goods and services is when you go to buy a two-wheeler. Let's say you buy the two-wheeler and along with it you get services. For the first 3 services are free. So there are 2 performance obligations here. One is the delivery of the vehicle and second is the 3 free services, right? So these 2 things can be sold separately as well. You can buy a vehicle without the 3 services which are free, and you can also get vouchers or free or the services also. So these are the distinct goods or services. So the second step is to identify the performance obligation. Okay, and performance obligation should be separately identifiable. That is a very important part, right? The third step is to determine the transaction price. Okay, now transaction price is the amount of consideration that an entity which is selling the goods expects to be entitled once it's fulfilled its performance obligation. So whatever is the consideration which it thinks it is entitled to if it provides the goods and services is nothing but the transaction price. So the third step is to determine the transaction price. Now there are various types of transaction price. One could be a variable consideration. That is, it depends on happening of a certain event. For example, a variable consideration could be a bonus or a penalty. If a contract includes a variable consideration, then the entity must estimate the amount it expects to receive, and it should recognize this as a revenue only if there is a high probability that it is going to receive that payment. Okay. Now, let's take an example about calculating the transaction price. Okay. On 1st January, Dell entered into a contract with a customer for sale of 400 laptops. Okay, the terms were that if the customer purchased 400 units in a year, the price would be $400 retrospectively. That means he doesn't have to purchase all the 400 laptops immediately, but over a year he has to purchase 400 laptops. Okay. And if he reaches the target of 400, then he will be priced at 400. Otherwise, the selling price would be 500. On 30th June, the customer had purchased 80 units. For the quarter ended 30th September, there was a huge surge in demand and the customer purchased additional 250 units. It was estimated that the customer would exceed the 400 unit condition. What is the revenue to be recognized for the 6-month period ended 30th June and the quarter ended 30th September? Okay, so please take your time to understand the question. If the customer buys 400 units in a year, the pricing would be 400 or else it would be 500. For the first 6 months, he has been able to buy only 80 units, which is not even 50% of the target which was given to him. Therefore, for the period ended 30th June, the 80 units which was sold, the revenue recognized would be at the rate of 500. So the revenue for the period, 6-month period, 30th June, would be 80 laptops multiplied by 500, that is 40,000, right? The second period, for the period ended 30th September, right? They have asked us for the quarter of 30th September. Now, by 30th September, the total units sold were 80 plus 250, because in the third quarter they have sold 250. So the total sales became 330. Now they have clearly indicated that the customer will be able to exceed the 400 condition, right? Therefore, now you have to recognize the revenue based on the selling price as 400. Okay, so the total 330 units will now be recognized as 400. So up to 30th June, 330 units, sorry, up to 30th September, 330 units into 400. So the total revenue to be recognized should be $1,32,000, right? But out of $1,32,000, you have already recognized 40,000 as revenue up to June. Therefore, revenue to be recognized for the quarter 30th September would be 1,32,000 minus 40,000, that is 92,000. This is how you will recognize the revenue, right? The next step, there are other forms of considerations as well. We had seen one was the other is financing. Sometimes a customer is given a very long credit period. So it is up to us to investigate and identify whether there is a financing component in this, right? So again, if there is a significant financing component, such as when the customer pays more than a year after receiving the goods, then we have to identify the interest element or the finance component in this, and we have to separate it from the sales revenue. So the consideration receivable will need to be discounted to the present value using the rate at which the customer borrows the money. Example on this, then there could be a non-cash consideration. In this case, it is measured at fair value. Many a times you have seen exchange offers, right? So you are giving your old product to when you're buying a new one. So that would be the non-cash consideration. So whatever you are giving non-cash consideration to the seller will be measured at fair value. Then there will be consideration payable to the customer. If the consideration is paid to the customer in exchange of a separately identifiable goods or services, then it would be treated as a purchase transaction. Now here the seller would be the buyer and the buyer would be the seller. So the entity is paying the customer for certain services. So that would be treated as any other purchase transaction. But if the consideration paid to the customer is not in exchange for a distinct good or service, an entity should account for it as a reduction in the transaction price. The best example for this is whatever cashback options that you get whenever you, especially online purchases, etc., that you make, the entity or the seller generally offers a cashback offer, right? So in this case, whenever you're getting the cash back, the entity has to record the transaction after reducing the transaction price. Okay, so let's do an example based for the financing consideration. An entity sold product to a customer for $50,000 on 1st Jan 2000. The terms of payment were that the customer would pay the full amount on 31st December 2001. So please understand, the customer has made a purchase on 1st Jan 2000, but he is going to pay only on 31st December 2001. So he is going to pay after full 2000 is over and after full 2001 is over. That means he is going to pay after 2 years. So what is the amount of revenue to be recognized on the date of sale? The cost of capital for the customer is 10%. So in this case, you will recognize the revenue which will be equal to the present value of the amount to be received after 2 years. Okay, so you can use a discounting table and find out the present value factor or the discounting factor. So the amount would be 50,000 multiplied by discounting factor of 10% for 2 years, which is 0.826. And the revenue to be recognized on 1st Jan when the transaction takes place would be 41,322. Revenue to be recognized on the sale of the product. I hope that was clear. Now let's go to the fourth step. Allocate the transaction price. Now, the total transaction price should be allocated to each performance obligation in proportion to the stand-alone selling price. Now, stand-alone selling price is nothing but if you wanted to offer the services or the goods individually, what would be the selling price? Like I gave you the example of a vehicle and three free services, right? If you want to sell the vehicle individually, what would be the selling price? That would be the standalone selling price. And if you want to sell the three services, what would be the cost of these three services? That would be the standalone price for the services. Okay, so whenever I go to buy a vehicle, I'm not identifying that for vehicle I'm paying so much and the services I'm paying so much. I'm just paying a lump sum amount. But IFRS 15 says that you have to bifurcate that lump sum amount between the performance obligations, various performance obligations, and that should be in the proportion of the standalone selling prices. If the standalone selling prices is not directly observable or possible to find out, then it must be estimated. But you need to allocate the transaction price between different performance obligations. Let's do a question here. On 1st Jan 2001, Reliance Jio gives its customers a free handset when they sign a 2-year contract for provision of the network services. The handset has a standalone price of $100 and the contract is for $20 per month. As per IFRS 15, how will the revenue be recognized? Okay, all of you are aware that Jio was giving free handsets if you subscribe to their network, right? We are taking the same example. Now, before IFRS 15 was introduced, since the handset was given away free, there was no revenue recognized against the handset. But now what IFRS 15 says is you have to allocate the transaction price between the performance obligations. Now you have to first identify the two performance obligations here. What are the two performance obligations here? One, it's the delivery of the handset, and second, you have to provide the network service, right? Now, the standalone price of the handset is $100. Now let's see how it goes. The standalone price of the handset is $100. It's given in the example, and the network is for 2 years at $20 per month. Okay, so that is their standalone service. Now this is the standalone cost of network service, but they are given. So total price should have been 100 for the handset, 480 for the network, and the transaction price should have been 580. We are adding the standalone rates and calculating the transaction price. So let's find out the percentage to the total. So the handset contributes 17% of the total transaction price, and the network is contributing 83% of the transaction price, right? Now, in the given case, the total transaction price is $480 only, right? 24 months into $20 per month. So the allocation of the transaction price will be as follows. Towards handset, 17%, which we calculated earlier, as I said, proportionate, right? So towards the handset, it is $480 into 17%. I have rounded it up to $82. And the balance would be 480 minus 82, 398 would be for the network, provision of network for 2 years, right? Therefore, for 1 year, the network provision, the revenue would be 398 divided by 2 years, 199. So, revenue for the first year would be, because you're delivering the handset, $82, and because the network for the first year has been provided, $199. So the total revenue would be 92 plus 199, that is 281. Okay, I hope this is clear. Now, Recognize the revenue. Fifth step is to recognize the revenue. The revenue can be recognized when or as the entity satisfies the performance obligation. Okay. Please remember, the revenue is recognized only when the performance obligation is satisfied by the entity or the seller by transferring the promised goods and services to the customer. An entity must determine the contract inception whether it satisfies the performance over a period of time or at a particular point of time. This is best explained with the previous example of Geo itself. Okay. Now, the revenue recognized for the handset will be at a point of time. The performance obligation is completed when you deliver the handset. So you will recognize the revenue related to the handset as soon as the handset is delivered to the customer. Okay. So on $82 will be recognized on 1st January 2001 itself. Okay. But the network is provided for 12 months. So per month, the revenue recognition would be $16.5, right? So go back to the previous calculations. You will see that the network revenue for 1 year was $199. Therefore, for per month, it would be 16.5. Now, network is something which you are providing over a period of time. So, each month revenue recognized would be 16.5. So, as soon as the month is over, you will recognize the revenue for that month. This is known as performance obligation over a period of time. Okay. So the network revenue will be recognized over a period of time. Right. Now, performance obligation is satisfied at a point of time. This is normally when the customer obtains the control of the promised assets. The entity controls an asset if it can direct its use and obtain the remaining benefits. So the indicators that the control has passed on to the customer includes the customer has got the physical possession of the asset. Now these are just indicators, okay? These are not the rules. These are just indicators. The customer has significant risks and rewards of ownership. The customer has legal title and the seller has the right to payment. So if these are the indicators in a given case, you have to look out for indicators to see whether the performance obligation is over a period of time or at a point of. Now, performance obligation satisfied over a period of time if one of the criteria is met. Now, these are the criteria. The customer is simultaneously receiving and consuming the benefits from the entity's performance. Take the example of the network. The seller is giving the network and the consumer is receiving the benefits of that, using the network. The entity is creating or enhancing an asset controlled by the customer. We would be doing contracts under revenue IFRS 15 in the second part of this presentation. So generally when we are saying an entity is creating or enhancing an asset, that means maybe he is building an asset for the customer or increasing the capacity of the building, etc. So it is enhancing the asset. Enhancing means increasing the value of the asset controlled by the customer. The entity cannot use the asset for an alternative use and the entity can demand payment for its performance up to date. So whatever work has been done, the entity has the right to receive payment towards it. If the performance obligation is satisfied over time, the revenue is recognized based on the progress towards completion. And the progress towards completion may be measured either using the input method or the output. This we'll be studying in detail when we do the contracts. Now, there are different types of contracts, other contracts. One is consignment or dealer. So, when goods are delivered as a consignment to the customer, in this case the dealer, he does not get the control of the products at the point and hence revenue is not recognized by the entity. The indicators of consignment are that entity retains the control of the product until specified event takes place, like the dealer or distributor sells the goods. Entity may require to return the product or transfer to another party. So if the sales do not happen, the dealer can return the goods to the owner, manufacturer. The dealer does not have unconditional obligation to pay for the product. So even if an entity delivers the goods to the dealer, then the dealer is not under any obligation to pay the amount. So there does not have to be an unconditional obligation to pay. So the dealer will pay only after the sales takes place. The other contract is principal and agent. So whenever you are trying to identify the transaction, you have to first identify whether the entity is working as a principal or an agent. When you say an agent, it means on behalf of the another party. So, if it is acting as a principal, the control of goods is transferred to the customer, performance obligation is satisfied, and revenue in the gross amount of consideration which it expects to be entitled to. Okay. So, if the entity is a principal, you will recognize the full amount of consideration that you receive as your revenue. But if the entity is acting as an agent, only the commission would be recognized as a revenue. Now, indicators that an entity might be an agent. Another party is responsible for fulfilling the contract. Entity does not have the discretion of deciding the selling price. Entity is not responsible for inventory before or after the customer orders. And entity is not exposed to credit risk. So here the only thing you need to remember is whether the entity is a principal or an agent. If it's a principal, the full gross consideration will be recognized as revenue. If it's working as an agent, only the commission would be recognized as a revenue. The other contract is repurchase agreement. Under repurchase contract, entity sells the asset and promises or has the option to repurchase the asset. Okay. In this case, the indicators of sale and repurchase is sale is below the fair value. Option to repurchase is also below the fair value. Entity continues to use the asset, and majority of the risks and rewards associated with the asset are with the entity. In this case, you will not recognize the sale as revenue. Let me give you an example. I own a building which has a fair value of $15 million, but I sell it to a party for just $8 million, which is way below the fair value, right? And when I enter into a sale agreement, I also put a clause that I will repurchase that asset after 5 years at 10 million. Okay, again, which is way below the fair value. Therefore, for this case, you have to look at substance over form. Even if I'm calling it a sale agreement, it is indicating that this could be a financing transaction where I continue to use the building, but the ownership is transferred to the buyer but basically I'm giving it as a security against the amount I'm getting from the buyer. So in this case, you will not recognize it as a revenue, but treat this as a borrowing transaction. The another contract is bill and hold. The goods are sold but remain in the possession of the seller for a specific period, but this is generally at the request of the buyer. So the indicators, you will recognize the revenue even if you have not given the physical possession to the buyer. The indicators are that the customer has control over the product. He has bought the products from you but not taken the delivery. So when he has bought, he has the control even if he doesn't have the physical delivery. Generally, the customer requests you to keep the product until a specific period. These products must be identifiable as belonging to the customer, and entity cannot use or sell it to someone else. So these are separately identifiable products as belonging to the customer, where the customer has requested that he will take the delivery after a certain period. It could be because of lack of storage facility with the customer, etc. In this case, even if the physical delivery is not transferred, the control has transferred, so you will recognize this as a revenue. I hope this was useful. Thank you.